Check 1, 2. It gives me the VU levels right there.
Yeah.
And then we got a preview of what's being streamed out there.
Yeah.
The blue light indicates it's streaming. Oh, record's not going. We can record. Hi, welcome to Management 1000. No, wait, this is Management 3320, Financial Management. We're live on the interwebs today. That's all there is to it. And then you go, we're just going to put the standby screen on. Here's the .cam live. Look at that. Look at that mouse action happening there. Yeah, so it's just grabs an IP off the network. There's no firewall issues or anything like that. Copy paste the matching code to YouTube. Like dead simple.
Yeah.
It's like holy cow. I thought it was going to be parameters and all this set up, and you can actually have multiple channels.
Yeah, that's okay.
So right now we just have one channel.
Yeah. So you could have your two screen if you had your two screens.
Right. So I could be recording like raw video without watermarks, and I could be streaming a channel that has like the logos and watermarks and stuff if you wanted to do that.
Yes, yeah.
But I don't care about that stuff. You can do monitoring if you want. And then there's .cam laptop. Whoops. The biggest problem I've got is the user interface. So I'll be here and I'll flick this to document camera and forget to flick this.
Okay. Yeah.
So it's like, so we got the screen, we got the
Right. Yes.
whatever. We can resize those however we want.
Jag skulle vilja ha en...
Anything but a Big Mac?
Kind of like a Big Mac, but juicier and tastier.
The burger Big Mac wish list.
We have the mic going. We can talk about what we're doing, and everybody can see that. Check 1 2. Check check. Check 1 2. Check check. Can you hear me in the back? Can you hear me in the back? Do 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 do. Ah, now you see it. What was it you were pointing out to him? Ah, that's why you're doing the. Up and down, side out. do 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 do. All right. All right, we'll get rolling here. Testing everybody's visual acuity skills this morning with find 6 differences, because we're going to need it later. Anybody find 6 differences? I know you guys found 1. You had 5. Which one did you find? Tree branch beside the owl. There's 1. What else we got? The little flame on the fire. There's 2. Star up there. There's 3. We'll go over to the side of the room. Tent peg. 1's missing. Oh yeah, we already got the branch by the owl. Oh, the pine tree. Yes, taller pine tree. Was that 4 or 5? 1 more. Visual acuity. Right by the tent peg, the ground is taller. There we go. So we got ground, flame, tree, tent peg, star, branch, 6 differences. Class number 9. Holy cow, term's going along quick. Here's today's agenda. So we will use Slido.com for the back channel. So if you go to Slido.com and choose hashtag SO1 for the course. Let me just get this going here. Let's see. Come on, technology. Okay, that should be working, I think, from your side. There we go. Okay, so Slido.com is going. What's the format of the midterm? I'll get to that momentarily. Here's the agenda for today. We'll do rip from the headlines, first 5. Is my first 5 person here? All right. I don't have it on here. I can pull it up, though, quickly. Sure. Okay. I have it on my laptop, too. This is the Japanese.
Yeah, so pretty much this article just talks about how Huawei, the Japan government, isn't going to buy their products anymore simply because of like cybersecurity reasons. And I'm sure you guys seen that the Huawei CFO got arrested recently, and this kind of ties in with our financial forecasting section, just because like we learned that in the pro forma statements, there's a lot of assumptions that need to be made, and that Huawei as a company, they're going to assume that they don't have this revenue coming from Japan, and they've already been blocked out of like Canada and the US from building 5G networks, just simply based on that trust with the Chinese government and things along those lines. So like when they're going to be building the pro forma statements and things like that, they won't be able to take into account their increased revenue from the Japan market. So.
All right. Thank you very much. So this is a big deal. TELUS is talking about they've already got Huawei gear installed, and if they rip that gear out, well, what's the market for this used gear? It might not have any resale value. So there's issues like that. Lots of interesting things about these stories. Everybody wants to know about the midterm exam. So that was first 5. We'll do rip from the headlines next. We'll talk about the Menatomi case in some detail, and then talk about what's coming up. So there were some questions about the midterm exam. It's next Tuesday. We're authoring it right now to go to the printers tonight or tomorrow. Right now we're looking at 3 problems, sort of 75-ish marks, so like a mark a minute. It'll cover stuff from chapters 1 to 3. Here's a hint. We already did 1 to 5. We already did chapters 1 to 3 on the quiz, so it'll focus on chapters 4 and 5. And there'll be problem-y type questions like the ones that we've been doing in class. So pretty much the same kinds of information that we did for the quiz. So I'll talk about that a little bit more. Here's ripped from the headlines. Anyone know what this story is from last week? What do you think? No, not funnel fries. Oh, maybe, I don't know. It's not about logo. It's about a ruling in the EU. So here, I'll run this little video clip for you.
Anything for a Big Mac?
Kind of like a Big Mac, but juicier and tastier.
The burger Big Mac wish list.
Anything but a Big Mac?
I'd like a Big Mac, but actually big. There you go. Thanks.
Big Mac-ish, but flame grilled, of course.
Anything but the Big Mac.
So that's the interesting bit is there was a burger shop in Ireland, and I think they had, the name was McSomething's Burger or something, and McDonald's came in like the 800-pound gorilla and said, "Thou shalt not use the name Mac anywhere in any of your advertising." And so this little burger chain took the big McDonald's to court in the UK, or in the EU, intellectual property, and the court came back and said, anybody can use the name. So Burger King got on board and said, it's like a Big Mac, but actually big. Kind of like a Big Mac, but juicier and tastier. Anything but a Big Mac. Big Mac-ish, but flame grilled. So they've just been trolling McDonald's with this. So it's really quite interesting, I thought. We already did first 5. So let's talk about Metatomi Home Health Services. There we go. I found this on the interwebs last night. This is fairly disturbing.
Hi friends, Metatomi Home Health Services, a growing home health agency, is experiencing cash flow problems. Students must prepare a cash worksheet and an SCF and compare the results to the accrual statements, which show an operating surplus. The CASESOLUTION.com is the #1 destination for getting the case study and analyzed. Thanks for watching this video.
So I have no idea why a young woman construction worker sitting in a war zone with bombed out buildings talking about case solutions. There are websites that will sell you the case solution. Don't go to them. Do the case solution yourself, because that way you get all of the learning. The first thing that we were going to look at was the cash flow worksheet. And I emailed around a spreadsheet to everybody. Hello? Hello? There we go. Now, I know at least one person was working on the spreadsheet because I was getting questions emailed to me last night. I got one projector working, the other 2 are not. Bad technology day. So there we go. So we have this cash flow worksheet. And in the example that I sent around, I did the first couple of months for you. And then we were trying to figure out the net inflow. And once we know kind of the net cash flow coming in and going out, then we can look at how they're financing this operation. Document camera. Let's see if it works this time. We got 2 out of 3 screens. We're almost there. 3 out of 3 screens. So again, we have cash coming in. How does this company earn their revenue? Okay, home health care service. Yep. Okay, so elderly people, right? They probably have some billings from the government. They have maybe a set sort of slate of services. So that's where the cash comes in. It's not like they have a product that they sell in the market. They're providing a service. This is a not-for-profit kind of organization. They have cash going out, and you can see we pay salary and benefits. We have overhead administration. We have accounts payable. And you can read the rest of those cash things going out. What was the question that you asked me last night?
It was about how do you show depreciation?
Right, so the question was, how do we show depreciation expenses on here? What's the answer to that question? You don't. Why is that? Right, it's not actual cash going in or out. So we buy a vehicle, and we have the $18,000 vehicle expenditure, and the vehicle is good for 48 months, and it depreciates at $375 a month. Right, but that's not actual cash money going out the door. So it's an accounting trick, but this is looking at the actual cash. So that was a good dialogue that we had about those kinds of things. Let me fire up the spreadsheet. Do. Not a Big Mac. There we go. Maybe I'll zoom in a little bit more so it's a little bit easier to read. So things that I did in this particular spreadsheet. Numbers that came directly from the case I left in black. Numbers that came from the from the balance sheet in the case I put into red because there's a subtle difference between them. And numbers I use in blue is sort of my convention of if you see blue, you know it's calculated. And then I have important in bold because some numbers are more important than other numbers, so they get a nice bold treatment. In the original exhibit from the case publisher, it just has a cash in row, and it's somewhat confusing to figure out where the cash in comes from. So what I did in the spreadsheet that I emailed out to you is I broke it up, and I said, okay, where's cash coming from? If we pick November, for example, the cash coming in November is the receivables from last month. So we're billing in October. We actually received the money in November. And then we have accrued revenue that's coming 1 month later. So you'll see last month's receivables, accrued revenue, and then we're subtracting off the accounts receivable for the next month. Whoops. So it has this kind of checkerboard pattern. I'll just highlight a few to kind of illustrate what's going on. So we have the accounts receivable in October. It's going to show up in our October books, but we don't actually receive the cash until November. And likewise, we have the billings for next month showing up in December's books, but we don't actually get the cash until January. So we can work through the numbers, and we can figure out the cash coming in. So in October, we have $6,400 in cash, and the rest of the months look pretty good, $48,000, $46,000, $70,000. And when we get up to springtime, cash goes way up. Why does cash go way down? What is it about this model that we see this pattern? What do you think? Exactly. So the revenue stream is seasonal, right? This is a home health services business. In the wintertime, the infirm, the elderly need people to come to their house, bring them meals on wheels and things like that. In the summertime, they're able to get out more, or their long-lost relatives and grandchildren can come visit them and things like that. So there's a seasonality to the business, and we see that reflected in the cash flow statement. So fall is low, it increases over the dead of winter, and then it slowly decreases again as we go throughout the year. So things that you should notice are, do the numbers follow the storyline? So if you saw the same cash flow across the entire year, you might want to say to yourself, something's amiss, something's not going on, because we're told that this is a seasonal business, that there's a seasonality to it. The next piece of the worksheet was looking at cash out. So we have salaries and benefits in October. And I put a little note here that it's payable, it's accrued in September, but it's actually paid out in October. So we see this accrual happening through a number of different items. And then we're told that everybody gets a raise in November, and it goes throughout the year. So everybody gets a raise from $35,100 to $41,250, and that goes throughout the year, except for this $30,000 in July. What's that all about? What's that all about? Right. So they're going away. We don't pay them their salary. Now, this is actually, again, I put a little note in here. It's actually accrued in June, but paid in July. So June is when everybody's taking their holidays. We write that in the books, but July is when we actually pay out the salary and benefits. The rest of these values are fairly straightforward to calculate. We're told overhead and administration is $180,000 for the year, so that's $15,000 a month. So again, you can go into your spreadsheet, put $15,000 in, drag it all the way across, and away you go. We're told accounts payable is $3,420 a month, but we have this little sniggling leftover from September. So we have to pay off $29.25 in October, and then the rest of the time we can sort of use this assumption of how much it's going to be for accounts payable. Same thing, contract services. You walk through the case, it talks about the data. There's a whole paragraph detailing all of the expenses, and we're told $900 a month. Put it in October, blast it all the way across, and you're good to go. Miscellaneous expenses, $1,500 a month, and away you go. And the last few are slightly trickier. So we'll talk about those in a little bit more detail. We decided to buy a van. We're going to take possession in December. It's an $18,000 van. We're going to pay for it in 4 monthly equal payments. So we take that $18,000 divided by 4, and we get $4,500 for January, February, March, or sorry, December through March, and away we go. This is exclusive of the depreciation, which is going to happen for the next 4 years. What other things we're told in this case? We are told in fiscal year 2011, we owe Dr. Wilson, one of the board members, $29,070 for a short-term interest-free loan she made to the agency. This amount is payable in equal installments in December and March. So you sort of go through the case, pull out the sentences, parse the bits. We got $29,070 divided by 2, 1 payment December, 1 payment in March. And what this case is setting us up for is a whole bunch of expenditures at a couple of different times, and we're going to need to take out our line of credit for that. We have equipment leases. Totaling $22,500, payable in equal installments December and June. So we take our $22,500, December, June. We have mortgage principal of $11,250, payable in March and September. So again, you grab those values and plunk them in there. The mortgage interest value, you can take the total interest we're going to pay on the mortgage. So 9% against the principal gives us $13,922. You could divide it by 2 and have equal payments. The way mortgages work is the first payment in March is slightly higher than the next payment in September. Let me just flash up the teaching note on the screen here for you. So here's how the mortgage interest works. We have $157,500 is the mortgage. 9% is the annual interest rate. There we go there. So we divide that by 2. And we have $7,088 in March. And in June, we have a decrease in our mortgage principal at $56.25, giving us $68.34 in September. Now, you could take the $13,922 and divide it by 2 and use the same amount for both. It won't impact the bottom line in September. It'll just make a small difference of a couple $100 as we go through the term. So again, some students will have simply divided it in half. That's okay. This is the more detailed, we take the principal payment off the mortgage and apply the interest and things like that. Yep. Now, if this was a case like for the team case assignment, there's always a variation in terms of what people assume and how many digits they use for decimal places and things like that. So if you said this is the interest and we're going to divide it by 2 and these are the two, that's fine. Where does it come from? I suspect it comes from the balance sheet. mortgage payable. Off the top of my head, I don't know. I'd have to go through the case and find it. Yes. It's payable in March and September, the calculation for June. I don't know. I suspect, I found bugs in the teaching note. So it talks about 2010, 2011, and then it says carry forward from 1997, 1998. So I think what the authors did was, actually I contacted the author of the case because I had some bugs in the cash flow statement. He said the case has been around for 30 years. So I suspect every 5 years they probably go in and change the dates. And it probably was something like a March-September split, and then somebody said, oh no, it should be a June-December split. Yes, that's what the case told us. We'll just go with the best available information. If we take, so the difference between these two is what, $200? 13,922 divided by 2. You know, you can do it that way and it'll be fine. The more important thing is we have the total cash in and the total cash out. So cash in we calculated above. So we have 6,000, for example, here in October. And we have 48,975 coming out. Oh, that's a deficit position. Or sorry, 55,000 coming out, leaving us negative 48, almost negative $49,000. So we take that and we go to the bank. Now we're told that our desired balance is $20,000. We have $22,860 in the bank today. That means we can take $2,860 and apply it against our line of credit, leaving us with $20,000 in the bank. But we have cash outflows of negative 48, so we need to make up the difference. So that's where this increase of 46,115 comes. So our line of credit starting with 65,400, add in 46,115, leaves us with 111,515. And once you can do that for the first month, then it's just mechanical across the rest of the months. So we're in a deficit position in November. Net cash is negative 13,920. We had 20,000 in the bank. We still have 20,000 ending balance because we're going to increase our line of credit by 13,000 from 11,000 to 125. Next month comes along. Our bank balance stays the same, but we're $46,005 in a deficit position. Increase our line of credit, 46,000. So we go from 125 to 171,400. And away we go. So we can look at this and we can figure out what's the maximum line of credit we need from the bank. So for these guys, probably $200,000 would cover it because we hit 171 here. And then things start to decrease. So we're cash positive in January. So let's take this cash and apply it to our line of credit. So bring our line of credit down $3,600 to 167. Cash positive, bring our line of credit down, and away we go. And my numbers are messed up because I changed these values up here. There we go. Your results might be slightly different, but I wanted to show that eventually in whatever month is in column J, May, we only have $980 left on the credit line. What comes after May? June. June comes along. We're $4,300 up. We pay off our credit line. So our credit line is at 0, and now we're cash above $20,000, $23,399. Then we start getting into a deficit position again and start with a line of credit again. So that's how the line of credit ebbs and flows as we go throughout the year. Questions at all about that piece? We could change those values and make the whole thing work out, but I wanted you to see sort of big picture how this works. Cash in, cash out. What's our net cash position? If we're negative, we need to borrow on our line of credit. If we're positive above our desired cash balance, we can pay down our loan, and then our loan or our credit line changes over time. That's the big idea. Questions about that piece? That was the cash flow worksheet. Let me check Slido. Are there past midterms? Yes, they open up on Thursday, and you can post answers at CourseLink for a bonus mark. Will the solutions for the case be posted? No. Format, 3 problems. How do you factor in depreciation for the case? We'll talk about that in a moment. That was a Slido back channel piece. Okay. How many people actually did this spreadsheet? I got 1, 2, 3, 4. I got a few people. 5. We didn't do the pro forma operating statements and balance sheets. But here is the operating statement. So what I'm going to do is I'll give you a couple of minutes. Look at this. Talk to your neighbors. And then tell me what you see. What information does this provide us? Put on some thinking music for you. Dave. So the question came up on Slido, how do we deal with depreciation? And the answer is we would put it into the equivalent of our income statement. In this case, it's called an operating statement, just because this is a not-for-profit organization. As follows: we have $33,000 depreciation. I believe that's on their equipment. And then we have $3,750 in depreciation for the van. So we take our $18,000 divided by, that should be 48 months, gives us $375 a month, times 10 months. So from December to September. So there's the van depreciation plus our existing depreciation. The rest of the information's either given in the case, or you can see the calculations, other expenses, 1,500 times 12, 900 times 12, and so on, which is basically the same information we had on the cash flow worksheet. So things that popped out for me was our gross patient revenue is almost $1 million, $987,000. Net patient revenue is $810,000. So we go from the gross line to the net line, we drop 18%. And that's contractual allowances and uncollectible accounts. So we have people that we're supplying services to that can't pay us, which maybe that's in our mandate. Maybe we have people living below the poverty line that are elderly that need our help, and we're not going to collect on those debts, which is fine as long as we have built that into our budgeting processes. Is there a way, is there any tools that you might have seen in this class that would help us understand this income statement better, or this operating statement? Why, yes, Professor Tucker, there is. I totally remember when you were talking about common size. So we can take the information we have for 2008, 9, 10, 11, and we can common size it by dividing by the gross patient revenue line at the top. So that's the big idea. So now we can see everything as a proportion of the gross revenue. So what do we got? Our net patient revenue is still hovering around 82, 83% of the total. So that's fine. We're consistent. We have these people that we know we're going to provide services to that can't pay the bills. That's great. What other stories come out of these numbers when we do this approach? What else?
Revenues like just barely cover expenses, which is okay because it's a not-for-profit.
Yep.
So as long as they can have their monthly costs or just costs in general covered, it's okay.
Okay, yeah, we're showing a little bit of a surplus each year. Now, is that enough of a surplus? I don't know. But we're showing a surplus each year. But there's things buried in these numbers that kind of give us a hint as to what's going on with this organization. What do you got? Down here? Yep. So we see that there's just a little bit of a margin of difference between those two. We've got 67% split between salary and benefits and admin up here, and we've got 57% or 77% over here. So salaries are decreasing slightly, but administration costs are going up. They're almost doubling. They go from 10% to 18% over here. So that's a big one, is why is our administration costs increasing so much? Most of the rest of these are fairly constant. So that's one diagnostic tool in our toolkit. We can do a pro forma balance sheet. And again, we know from the cash flow worksheet that we end the year with $20,000 in cash. We can figure out the accounts receivable, I believe it's given to us, and different things like that. Is there a better way to understand what's going on? To which you reply, well, yes, Professor Tucker, we saw that moments ago. Is there a way to give us a common-sized balance sheet? And the answer is, ta-da, common-sized balance sheet. So what I'll do is I'll put the thinking music back on, let you talk to your neighbors, and we'll talk about this in a moment. What's going on with this common-sized balance sheet? Yes. Yep. Let me see. Doodle-doo-doo. Is it on the it's in the data paragraph? Oh, right. Yeah, the depreciation forecast to be 33,000, yeah. Yeah, that's the problem with these cases. Is sometimes you read through them and you go, where was that piece of data again? See, all those, you know, find six differences pictures will come in handy. So what does the common size balance sheet tell us? What's going on with this organization? What do you see? What pops out at you? What do you got? Accounts receivable is going up. Yep. What else? Cash is going down big time, right? It's dropped 8 times from 25 to 3%. Okay, so cash as a proportion of assets is dropped precipitously. Inventory is about the same. Prepaids and total current assets, again, they're going down. So if our current assets are going down, what does that mean? Well, assets are pie, so if half the pie is shrinking, the other half of the pie must be increasing. And we can see that where the property and equipment has gone from 54 to 68%. So it's increasing as a proportion of total assets. So we're getting more fixed assets and financing them, and we have less current assets. So we can see that up there. How are we financing these assets? Here's a hint, it's a not-for-profit. There's only one way to finance it. Gentleman in the toque. Exactly, they're taking a line of credit, right? We don't have shareholders we can go to and say, You want to buy some shares in McDonalds Home Services. So we go to the bank. We get a line of credit. So the line of credit has gone from 0. Now it's 70% of our total liabilities side of the equation. What else is happening? Anything else exciting on that side? That's really the most notable thing. So current assets going down, fixed assets increasing. When we're financing our fixed assets, our long-term fixed assets by short-term line of credit. So that's what's going on with that story. And again, the one single balance sheet on its own won't give you that, but if you look at it over time, now you have this information. So I was just taking the information from the case, I calculated this piece, and then sort of pulled them all together, divided by total assets, and now we have more information we can start answering different questions with. Okay, here's a little cognitive break for you, courtesy of our friends at Duke University.
This man is an expert in servicing your Schick electric razor. He's the factory-trained man at your Schick electric shaver shop. It's his job to give your Schick razor expert care. When you take it to him, he'll give all motor parts a thorough cleaning, oiling, and precision adjustment. You'll check the shaving head to make sure normal use hasn't reduced efficiency. In fact, he'll give your Schick a complete factory-approved tune-up, so you'll get a closer, faster, more comfortable shave. Take or mail your razor to your Schick electric shaver shop tomorrow. He'll be ready for you the same day, working like new. Look under Shavers Electric in the yellow pages.
What things in that ad no longer exist today? Yellow pages. Yeah, that's a big one. What else? If your electric razor, gentlemen in the crowd, if your electric razor dies, what do? Put it in the recycling bin, right? Nobody fixes things anymore. Anyways, moving right along. Let's see what's on the Slido back channel. Can you show us the case Excel sheet one more time? I want to verify my answers. Yeah, we can do that. How do we get the third-party payable? This is what someone was looking for. Okay. The problem with the case is it's so much easier when it's in PDF and you just type in your search term and find it right away. Third-party payables. We have $14,000 for interest payments and so forth is $7,043 per payment. That's that piece. Where do we find that in the case? Third paragraph from the bottom. The only other expenditure Mrs. Ringer or Ms. Ringer anticipated was $14,086 due to Medicare for payments received. And away we go. So there's that. Okay, what I'll do is I'll move along. Pro forma cash flow statement. So again, I didn't ask you to do this, but I'll flash this one up here for you. Here's a cash flow statement. This is for 2010-11. When you do a cash flow statement, the questions you always want to ask yourself are, what are the biggest sources of cash? What are the biggest uses of cash? Sources of cash, uses of cash. And again, normally you start net income at the top, add back in depreciation. Here we call net income excessive revenue over expenses. We have depreciation. And then we just work through investing in the vehicle, financing the mortgage piece. And then we have the operations piece that you can see there. What is the biggest source of cash for these guys? What do you got? Yeah, so we got $44,000 and change increase in line of credit. Biggest source of cash. That's not exactly what you want. You want to have biggest source of cash, billings to Medicare, say. But that's our biggest source of cash. Second biggest source of cash would be salaries, benefits. What about decreases or biggest use of cash? The biggest source of cash is the line of credit. What's the biggest use of cash? What do you got? The which? Right, payment of the note. So this was the Dr. So-and-so loan is $29,000 interest-free. So we're basically robbing Peter to pay Paul, right? So we've used a bunch of cash to pay down this note, but we've needed a bunch of cash from our credit line to make that happen. So sources of cash, uses of cash. Again, these are diagnostic instruments. Ratios analysis, everybody's favorite topic. So what I'm going to get you to do is you guys are going to look at the profitability ratios. You guys are going to look at the liquidity ratios, and you guys are going to look at the asset management ratios. So you have all of the numbers in the case pack for the 3 years, 2008, 9, and 10. You guys are which again? Profitability. So just the two that I had in the email. You guys are liquidity. And finally, asset management, says everybody in the back row. Okay, so take a couple of minutes, work on those ratios, and we'll talk about them in a minute or 2 or 5. All right. Let's take a look at these ratios. So again, instead of using sales, since we don't have any sales, we use net patient revenue. And since we don't have any net income at the bottom line, we'll use excessive revenue over expenses as our bottom line. So we're just using the same concepts, top line, bottom line, but slightly different wording for the profitability. Did anybody here come up with a profit margin for 2008? Is this working? Oh, got to jam this back in. There we go. Profit margin. Everyone's too shy. So I didn't throw the values in, I just threw the final result. And if this was me on a midterm exam, I'd only get 1 mark out of 3. So there's the 2008 numbers. So again, excessive revenue over expenses in your numerator, net patient revenue in your denominator. And then for ROA, same kind of idea. Net assets in the denominator. And there's the values. So the first 3 values we calculate from the information given to us in the case. The last value we calculate from the pro forma documents that we created. Which is great. We can calculate. This is just kind of mechanical plug and play. What's the message? What's the story that the numbers are telling us? What's the story? Instead of find 6 differences, find 2 differences. What do you got? They're not profit, but they should be having some sort of margin. But we're seeing a drop-off, right? 10-fold drop-off in margin. Likewise, the return on assets. Again, they're not-for-profit organizations, so you don't expect them to be making lots of money. But if this is sort of typical how they were doing, now we're seeing they're decreasing by 8 times their returns on their investments. Could be a problem. Liquidity ratios. Again, use current assets, current liabilities like we would normally do for the current ratio, but for the quick ratio, we're using just cash plus accounts receivable. What did you guys get for the current for 2008? We didn't. Just go to the balance sheets and grab those numbers. So 3.5, 1 point. Yep. Okay, and what was the last one? 1.1. So I took mine out to 2 decimal places. You had yours at 1 decimal place. And again, these are fairly easy to calculate. Just go to your balance sheet, grab the 2 numbers you need, plug and play. What's the story? What's the message? What is it that the numbers are telling us that we as financial managers need to make decisions about? What's the story? Right, we have this 2-phased approach. Current assets going down, current liabilities are going up. We saw that our cash is decreasing, but our line of credit is going up. So our current ratio is getting impacted, right? If we quickly have to pay off some bills, collect on our accounts receivable and use some cash, we're going to have some trouble covering those current liabilities. Could be the payment on the line of credit, whatever it might be. So that's a big deal for this organization. Asset management. And again, we're looking at average days receivable and average days inventory. The idea was we'd have accounts receivable divided by net revenue, or 365. Did you get a value? Yeah. I got very different results. I don't know where we have differences. Maybe the 365 piece, use net revenues. Okay. Here's what I got. 35 days receivables, 36 for 2009. So that's accounts receivable divided by net revenue divided by 365. What's the difference? That would be it. Okay. Average days inventory. So what are the stories here? What's the story behind this number? How are we managing our assets? What's the story? What do the numbers tell you? Should have brought my Harry Potter magic wand, right? Reveal your secrets. What's the story that the numbers are telling us? We're taking longer to collect on our bills, which is impacting our cash flow. I don't know what kind of inventory these guys have, if it's medical supplies or what, but we're talking more than a year, and we've come down to just under a year, right? Maybe if we can reduce the amount of inventory sitting around for really, really long periods of time, that'll improve our cash flow. So again, this gives us management some insight into where they could look. Do we need to have a year's worth of inventory sitting on the shelves, or can we free up cash that way? The other thing we have lots of fixed assets, but we're financing with short-term credit lines and things like that. Is there a way? Maybe we should go to the bank and have a longer-term financing plan. Increase our mortgage versus increase our line of credit. Questions, thoughts, comments about that stuff? Let's go to Slido and see what is going on there. Explain the profit margin again. Okay, the formula for this case was excess of revenue over expenses divided by net revenue. That's that. Here's what's coming up. So Thursday's class, we're going to look at Starwood Hotel. So the annual reports for Starwood are posted on CourseLink, and I'll post some fill-in-the-blank ratios. So we have 2013, 2014. We'll do the ratios, and we'll figure out the story for Starwood. We'll do a midterm exam review, which is 2 problems from Chapter 5. Old midterm exams are available on CourseLink. They'll open up on Thursday, and they're provided as is. If you want to do a solution and post it at CourseLink discussion boards, I'll look at it, give you some feedback, and there's a bonus mark for that. Excuse me, CourseLink quiz number 5 on Chapter 6 opens Friday, closes Sunday at midnight. Just the usual, read the chapter, do the 10 multiple choice questions. Tuesday we have a midterm. It covers chapters 1 to 5. Again, most of the emphasis will be on the latter chapters, 4 and 5. It's single stage. We don't have any assigned seating and working in teams and things like that. 3 problems, I think. We haven't finalized the exam. It's being written up right now by one of the other profs, but we'll probably go with 3 problems, the sort of things we've done in class. And then Thursday before reading week, we'll attack Chapter 6, working capital. There's a question. Oh yeah, we'll post the cover page of the midterm exam, but the formulas for the ratios and stuff will be there. The RNF, DOL, DFL stuff won't be. Other questions? There's a question. Yeah, I could do that. Yeah. Sadly, we're done early, so that's all I got. And it's not 40 below outside, so that's also good. Freeze, freeze, freeze.